Have you ever stared at your retirement account options feeling like you're trying to decode ancient hieroglyphics written by caffeinated financial advisors? You're not alone. When most people open up their 401k, they're greeted with a bewildering array of fund names that sound like they were generated by throwing alphabet soup at a wall. Large cap growth, mid cap value, international emerging markets, target date funds, and somewhere in that maze of confusion sits something called the S&P. Now, if you're like most people, you've probably heard the term S&P 500 thrown around more than a football at a tailgate party, but you might not actually know what it means or whether you should care. Maybe you've seen it mentioned in news headlines when the stock market has a good day or a terrible one. Thinks he's the next Warren Buffett keeps talking about it during lunch breaks. Either way, you're probably wondering if this mysterious S&P 500 thing is something you should be investing in or just another financial buzzword designed to make you feel inadequate. Well, here's the thing that might surprise you. The S&P 500 isn't just some random collection of stocks that Wall Street executives picked out of a boring meeting. It's actually one of the most important measurements of how the American economy is performing, and understanding it could be the difference between retiring comfortably and working until you're 90 because you thought investing was too complicated. My name is Nick, and I spend way too much time thinking about money, investments, and why most people would rather learn about their retirement accounts. If you're someone who wants to understand how to build wealth without getting a PhD in finance, make sure to hit that subscribe button if it helps you make sense of this whole investing thing. Here's what most people don't realize about retirement planning. The average person will change jobs and each time they do, they're faced with a new set of investment options that look completely different from their last employer's plan. One company might offer 15 different fund choices, while another offers 50. Some have fancy names like Aggressive Growth Portfolio, while others have boring names like Stable Value Fund, and somewhere in that mix, you'll almost always find an S&P 500 index fund option. Shows up everywhere isn't because fund companies are lazy or uncreative, it's because the S&P 500 represents something pretty remarkable in the investing world. Think of it as the ultimate popularity contest for American businesses, except instead of voting for prom king, we're measuring which companies are actually worth the most money. But before we dive into what's so special, let me ask you something. When you think about the most successful companies in America, what names come to mind? You're probably thinking about Apple, Microsoft, Amazon, Google, Nvidia, maybe Netflix or Tesla. These aren't just companies you've heard of. They're companies that have fundamentally changed how we live, work, and spend our money. Well, guess what? Most of these companies are sitting right there in the S&P 500, and when you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all of them at once. Now, you might be thinking this sounds too good to be true. How can one investment give you exposure to hundreds of the most successful companies in America? And more importantly, why isn't everyone doing this if it's so great? These are excellent questions, and they get to the heart of why understanding the S&P 500 is so important for anyone who wants to build wealth over time. The S&P 500 is what's called an index, which is basically a way of measuring how a specific group of stocks is performing. Just like how the temperature outside gives you an idea of whether you should wear shorts or a winter coat, the S&P 500 gives investors an idea of how the overall stock market is doing. But unlike checking the weather, which tells you about right now, the S&P 500 can help you understand long-term trends in the American economy. Here's where it gets interesting. The S&P 500 doesn't just randomly pick 500 companies and call it a day. There's actually a committee of very serious people who spend their time analyzing companies to determine which ones deserve a spot in this exclusive club. Think of it like the admissions committee for the most prestigious university in the business world. Except instead of looking at test scores and essays, they're examining things like market capitalization, financial stability, and trading volume. To get into the S&P 500, a company needs to meet some pretty specific requirements. They need to be based in the United States, they need to be worth multi-billion dollars, and they need to have been profitable in their most recent quarter. They also need to have been publicly traded for at least a year, which means no brand new companies that might disappear as quickly as they appeared. This screening process is actually one of the reasons why S&P 500 index funds have been so successful over time. You're not just buying random stocks and hoping for the best. You're investing in companies that have already proven they can survive and thrive in competitive markets. It's like having a team of professional scouts pre-select the players for your fantasy sports team, except instead of trying to win your office league, you're trying to build wealth for retirement. But here's something that might surprise you about how the S&P 500 actually works. Even though it includes 500 different companies, they're not all treated equally. The bigger and more valuable a company is, the more influence it has on the overall performance of the index. So when Apple has a great day and its stock price goes up, it affects the S&P 500 much more than if a smaller company has the same percentage increase. This means that the top 10 companies in the S&P 500 actually control nearly 40% of the entire index's performance. We're talking about tech giants like Apple, Microsoft, and Amazon, along with companies like Berkshire Hathaway, Tesla, and Johnson & Johnson. When these companies do well, the entire S&P 500 tends to do well. When they struggle, the whole index feels it. Now, this concentration in large companies isn't necessarily a bad thing. These are businesses that have proven they can generate massive amounts of revenue and profit. They've survived economic downturns, adapted to changing consumer preferences, and continued growing even as smaller competitors have fallen by the wayside. In many ways, investing in the S&P 500 is like betting on the continued success of American innovation and entrepreneurship. But here's where things get really interesting, and this is something most financial advisors won't tell you because it doesn't involve selling you expensive products. The S&P 500 has a track record that would make most professional money managers weep into their $1,000 suits. Over the past several decades, this seemingly boring index has consistently outperformed the majority of actively managed funds, despite having fund managers with fancy degrees and even fancier expense accounts. Think about that for a moment. You've got teams of highly educated professionals spending their days analyzing company earnings reports, meeting with executives, and trying to predict which stocks will outperform the market. They're getting paid millions of dollars to beat a simple index that just follows a set of rules. And yet, year after year, most of them fail to do it. It's like watching a group of professional chefs lose a cooking competition to someone following a recipe they found on the back of a cereal box. The numbers don't lie, and they're pretty embarrassing for the active management industry. According to research from Standard & Poor's, over the past 15 years, roughly 90% of actively managed large cap funds have failed to beat the S&P 500. 90%. That means if you picked 10 random fund managers and gave them your money, 9 of them would have done worse than if you had just bought an S&P 500 index fund and took a 15-year vacation. Now, you might be wondering how this is even possible. How can a fund that requires zero human decision-making consistently outperform funds managed by people who supposedly know what they're doing? The answer lies in something that sounds boring, but is actually fascinating when you understand how it works. It's called the efficient market hypothesis. And while that name might make your eyes glaze over faster than a donut in a bakery, the concept is actually pretty straightforward. The basic idea is that stock prices already reflect all available information about a company. When news comes out that Apple has invented a new product that's going to revolutionize the tech industry, that information gets incorporated into Apple's stock price almost immediately. There are thousands of professional investors watching every piece of news, every earnings report, and every market trend. They're all trying to find stocks that are undervalued or overvalued, but because there are so many smart people doing this, it becomes incredibly difficult for any one person or team to consistently find opportunities that everyone else has missed. It's like trying to find a $20 bill on the sidewalk in Times Square. Sure, occasionally someone might drop money, But with millions of people walking around looking at the ground pretty quickly, the stock market works similarly, except instead of looking for dropped money, investors are looking for mispriced stocks, and there are computer algorithms that can spot and act on price discrepancies in milliseconds. This brings us to one of the most important concepts in investing that most people never learn. It's not just about picking good investments, it's about avoiding investments you can make, is paying high fees for performance that you could get cheaper elsewhere. When you invest in an actively managed fund,